Good afternoon, everyone. This is Bill Even, your CEO at the Pork Checkoff in Des Moines, Iowa, welcoming you to the October Pork Producer webinar, which is going to focus on risk management in pork production. On the next slide, wanted to make sure we touch on our antitrust compliance, and the National Pork Board does take this very seriously, and all the information presented here today is designed to follow the nation's antitrust guidelines. On the next slide, wanted to make sure everybody's aware that Pork Checkoff funds are being used to host the webinar, and the purpose of this is to facilitate your understanding of publicly available information, and in this case, to help you out with risk management in pork production. And we believe that the pork industry and ultimately consumers are going to benefit from a better understanding of the economics of pork production and sales. And then the last bullet point, the views expressed by our guests are theirs and not those of the National Pork Board. So on the next slide, I wanted to show you where you can submit your questions. We're real pleased to have three speakers here today that'll be more than happy to take your questions. And on the sidebar, you're going to be able to go into the question box, go ahead and type it in, make sure you're using brevity and clarity so that we're able to answer that question later on at the close of the webinar today. So on the next slide, I did want to alert you to another event that's happening later this week, Thursday, October 29th. The Pork Checkoff is sponsoring an AgriPulse seminar called How Pork Exports Can Help Save Your Bacon. We're pleased to have those three panelists coming up here later this week, Undersecretary Ted McKinney with the USDA, Jan Archer, former board president of the National Pork Board and North Carolina pig farmer, and Dr. Dermot Hayes from Iowa State University. You can see the registration link at the bottom, pork.to/export-webinar, or you can reach out to anybody here at the Pork Checkoff to get registered for that AgriPulse seminar that we're sponsoring. So on the next slide, we're going to dive into the speakers we have today. First off, we're very pleased to have Mr. Tim Andreessen, the Managing Director of Ag Products from the Chicago Mercantile Exchange. Tim is going to cover off on some items you're going to find of interest around futures risk management. Dr. Steve Meyer, many of you know Steve. He's the economist with Partners for Production Agriculture, formerly known as the Kearns Group. And then to close out is Dr. Lee Schultz, the professor at Iowa State University, is going to talk a bit on marketing as well. And with that, Tim, I'm going to turn the presentation over to you and take it from there. Thanks.
Thanks, Bill. I hope my videos or my audio is coming through fine. My name's Tim Andreessen. I'm the Managing Director of Ag Products for CME Group, and I'm here just to give you a little bit of background around the upcoming pork cutout futures and options contracts, which are going to be launching on November 5th. I'm not going to get into the details too much because you got Dr. Meyer and Dr. Schultz are going to talk about the products, risk management around these things, and they can do a much better job than I can. But I'm just going to give you a little bit of why we think this is the right time to have this product. Before I do that, though, I want to thank all of you because we really appreciate your support of our products and your use of our products in risk management. And I just want to be really clear that, you know, our objective is to have effective risk management products for commercial agriculture. We think that's really important. You know, people occasionally say, well, you know, CME has gone on to be a whole lot more than just agriculture. And we have a global business in a lot of different asset classes, but deep in our DNA is agriculture. And, you know, our executive chairman and CEO, Terry Duffy, you know, started in the pork space, and ag is very near and dear to our heart. So we're always keen to make sure we're serving our customers well, and we're always open to feedback. A lot of where we've gotten to with this contract is because we've gotten good feedback from people in the industry. So thank you very much for that. You know, if you go back to the 1960s when the first contract came out, there was only one transaction type, and that was negotiated trade. And so it was very easy to look at this contract and say, this is fantastic. It's a great hedging tool. But, you know, one of the things that we've seen in markets is they've evolved. And this happens in grains, it happens in livestock, it happens in everything. But particularly in the livestock markets, we've seen this evolution where there's more and more different types of marketing tools develop. And you can understand why. It makes sense. People want to develop a deeper relationship with their suppliers. People want to get premiums for the animals they're selling and all that sort of thing. So, since 2001, when negotiated trade was down to about 20%, we've seen it drop to, single digits. And, that does concern us, because one of the key things you need for an effective market is you need price discovery. So back in 2015, we started talking to folks a little bit about the cutout and the role of the cutout in marketing. And we started publishing the pork cutout index. And we didn't necessarily at that time think we needed to launch a contract, but we thought having that data out there and visibility of the index would be good for the marketplace. For a long time, one of the things that really struck us is that there's been a strong correlation between the cutout and, the lean hog index. It's been high. It's been, over a long period of time, about 88%. You have to be careful with correlations, though, because correlations are time sensitive. And, I think you can get a correlation between darn near anything if you look at a really, really long period of time. But what we've seen, and as a hedger, you're not hedging for the life of something. What you're really looking at is you're looking at what's the effectiveness during the window that I'm holding that hedge. And, we've seen, as this pandemic has occurred, a lot of change in that relationship. And I think Dr. Meyer is going to go into that. So, we've seen that drop from, March through May. It was more like 53%. So that made it a less effective hedge. And at the same time, as we're talking to people in the marketplace, we're hearing more and more people are not just simply using lean hog as the baseline for any kind of a formula pricing mechanism they have, but they're also starting to implement portions of the cutout. So based on that, based on feedback from the organization here and a lot of customers, we decided it was probably time for us to look at launching a pork cutout contract. Can you next slide, please? You can skip this one. So, as you see, there's been a reasonable relationship, but we've also seen breakdowns in that relationship, and you can definitely see it here in May of this year. Next slide, please. So the key things about this contract: number one, the contract is the same size as a lean hog contract, 40,000 pounds per contract, traded in U.S. cents per pound with a tick size of 25 cents a hundredweight, which is $10 a contract. It's financially settled to the CME pork cutout index. That index is a 5 business day weighted average of prices reported by USDA and published daily. And the contract months align with the existing lean hog contract. Next slide, please. I'm not going to go through all of the details here, but if you look at these two side by side, and you can find all of this information on our website, and if you give me a second, I'm going to tell you that that is at CME Group, CME Pork Cutout Futures and Options. If you search for that, you'll find all of this information. You can see the trading hours are essentially the same as the hog contract. You can use CME Clearport to trade this. The months are the same, the tick size. We will be launching both futures and options because we think it's important to have options. Next slide, please. They are American style options, so they're similar to the options we have on all of the other contracts. Again, it's settled to the index, and probably don't need to worry too much about the block stuff or the position limit things. The contract will start trading, and I just want to be really frank with everybody. Getting a new contract up is a difficult thing to do. and we really need industry support. Now, everybody has said we're looking for this contract, we want this contract, it's important to us to have the contract. And it's out there. But to begin with, you're not going to see the kind of liquidity you're seeing in the hog contract. It's going to take some time to get going. And the best way we can do that is not to have everybody kind of sit there and say, well, when everybody else trades, I'll start trading it. We really need people to start trading on day one. We are going to have market makers there, so you'll see prices and we will create liquidity. But we really need people to try this contract out, put a contract or two in. Don't have to go big, but if we don't get that ball rolling, it's going to be much more difficult to get this contract started. So it's really critical that we get your support on this. We think that this is going to be an extremely useful tool for the industry to manage risk. We're very optimistic about it, but the toughest thing, again, is to get this thing going. So we really will look for your support in doing that. Next slide, please. Like I said, I'm not going to spend a lot of time talking about this. We got a couple folks here that can do a much better job doing that. And I'm going to turn this over to Dr. Steve Meyer, who has been somebody that we've certainly had a lot of conversation with around this contract in the development stage. Steve?
Thanks, Tim, and good afternoon, everyone. Let's get right to this. We want to leave Lee as much time as we can to tell us about markets. So, Nate, if you'll go to the next one, seems like everybody has a disclaimer today, and here's mine. We are an introducing broker for StoneX. Everybody's also changing their name these days, too. That used to be FC Stone. Of course, Partners for Production Agriculture is our new name. It's always been Kearns and Associates, but you'll see PFP Ag as we go forward. Next one, please. This is basically the facts of the contract that Tim just went through. And Tim, I had November 9th here. You said November 5th. So we're gonna come back to your questions. I want you to clarify that. So
it is.
Let's make sure we're all.
I'm pretty sure it is the 9th.
Oh, yes. Okay. All right. November 9th. 40,000 pounds, 8 contracts a month, same as lean hogs. Initially, daily limits are 450 and 675. Cash settled to the cutout index. This is all familiar stuff for us. 10th business day, position limit, reportable position is 25 contracts. So that's all kind of the facts of the thing. Let's go to the next one. Here's the history of the cutout index. It started in 2015, and of course it's a 5-day weighted moving average of the 602 cutout, the afternoon cutout. So you've seen this chart in other forms, exactly, but sort of. This will smooth that data a bit, but just so you've seen what it's done, the wild gyrations we've had this year because of COVID disruptions have been reflected in this cutout value. Okay, let's go to the next one. I think this isn't a new idea, and it was floated several years ago, and at the time I was opposed to it. I told, and as Tim alluded, these things were highly correlated, and so when they first brought this up, I said, wait a minute, you got something that's correlated very highly. What's going to happen here is if anybody trades that one, it's just going to cannibalize the volume and open interest in the lean hog contract, and I'm afraid that's going to make it less of a hedging tool and hurt it. That was back before really we started to move toward cutout value pricing. It was back when we had some more hogs on a negotiated market, but still, I was very concerned that it was going to cannibalize that one. Next slide, please. I've kind of changed my mind on that. Can we have the next slide, please? It says I'm having network problems. Can somebody talk to me here, please? Hello?
We can see your slides, Steve. The slide that is on the current is pre-2019 cutout lean hog index producer slide page.
All right, I'm going to monitor them just on my own here. All right, here we go. Let's go to that one. It's not updating on my screen, but now I know where I am. We're okay. All right, this chart shows a table of correlation coefficients. And Tim talked about how these were correlated. And if we go back before 2019, and Tim, this situation with the change in correlation actually started before COVID. You can go back here, and I kind of looked at the data and said, when does this look like this correlation really started to fall apart? And my conclusion was it was in early 19. So up to 2018, I would direct your attention to the first two columns here, and notice that the cutout was highly correlated to the lean hog index. It was highly correlated to the producer sold hogs, and it was highly correlated to just about all the cuts. There's only one cut down there that really wasn't very well correlated to the cutout. And if we look at the lean hog index, the same was true of it. Very highly correlated to all these other prices. And so if you look at that situation, you say, well, gee, I'm not sure we need a cutout and a lean hog contract because they were both very highly correlated. But that changed in 2019. If you go to the next chart, you can see here that negotiated prices started to really separate from other prices, including the swine and pork market formula, including other market formulas. And in about mid-2019, they really started dropping. And part of that, we got into some problems with packing capacity, and in that situation, you'll have that spot market quantity that might be a mismatch with what packers need, and so you'll have that price fall more. And of course, we've had that in spades if we've gone through the coronavirus situation. If we go to the next one, this one just shows the cutout value. It shows the swine and pork the lean hog index and the negotiated price. And you can see that the lean hog index is not very close to the negotiated price anymore. So what does this mean? Well, it means that the basis, if you're selling hogs on negotiated prices, and that's the base of your formula, or you're doing negotiations every day, that means that your basis situation is not as predictable as it once was, because the important relationship here is the lean hog index. That's what people are trading on the futures contract. So when those things start separating, you start saying, well, wait a minute, this isn't going to be a very good thing for trying to hedge hogs on a contract that isn't moving in lockstep with the price that I'm getting out there. And so I went, and if we look at the next one, 2019 through August of 2020, you can see that these correlation coefficients have all changed. I mean, there's not much correlation between individual, between producer sold hogs, the lean hog index, and the cutout, all the way down into the 0.6, 0.64 range. If you look at the lean hog index and all the other cuts, those correlations are terrible. All right, so you don't have much of an opportunity to hedge hogs or hedge other cuts against the lean hog index the way it's constructed by itself at the moment. That there's problems there. So what will the pork cutout value contract provide? Well, that's the next slide. Producers, you can directly hedge any hogs that are priced off the cutout value, and we know that percentage has grown. I think it's going to grow more in the future, and so this gives you an opportunity to directly hedge those. Maybe hedge a meat margin. It's all going to be based on the difference between the cutout and the hog price. We don't know how that's going to perform right now, but it's possible that you could hedge a meat margin on top of your hogs. Packers, you're going to be able to directly hedge revenues because the cutout value represents the weighted average of all the pieces of product that packers sell, at least at the wholesale level, and then more accurately hedge prices of individual cuts. We think that it's going to be a real opportunity on that because of the higher correlations to hedge hams or bellies or whatever in the cutout contract, a better opportunity than it was in lean hog. Finally, for pork buyers and end users, we think, again, they can more accurately hedge the prices of individual cuts which they're purchasing, again, because of those same correlations. Next slide. There are some potential negative impacts. Number one is there's going to be some confusion, and everybody's going to have to do their homework here and know the difference in these and realize which contract I'm looking at on the quote page. There's still considerable risk of cannibalization of volume and open interest. Will one of the contracts win and the other one lose? We don't know that over time, but I think there's a lot of risk. There's some risk of that, and I think we have to watch that carefully. The good thing is, Tim, that this The lean hog contract has been pretty successful, and in most cases, at least for the front 3 or 4 contracts, we have very good open interest and volume on a daily basis, which allows some liquidity there. It means that you can get in the market and sell some contracts, maybe not a real large number, without really changing the price in there. The bid-ask spread won't be too wide. So hopefully we can continue that, but this is a possibility. And finally, it's a very real possibility in my mind that the lean hog contract may go back to just being a hog contract. Then you would have a cutout contract and a hog contract. The two would have more clearly defined indexes that settle them. You would have better behaved basis on both of those on the lean hog contract. If it was just a hog contract, it's really this is really dependent on what Congress does in reauthorizing mandatory price reporting, which we have asked for them to separate cutout hogs from hog market hogs, from swine market formulas in the report. We've lumped those together back in 2001 when we started mandatory price reporting, mainly because at that time we knew it was going to change, but there weren't very many on the cutout value. Now that number is really influencing the lean hog index, and so we think that separating these would be a good idea. CME will decide what they do with their index. They're the ones that own the lean hog index, but given separate pieces of information, they could separate that and make the two contracts separate. So I think this is a new tool that, because of the changes in correlation over the last 2 or 3 years, brings a new, real, potentially useful tool for both producers and packers to use in hedging price risk, and bringing it on along with options to go with that. I think is very, very good, because there are situations where options are just a better tool to use than our futures. So with that, I'll close and let Lee come on and talk to us about what is expected in the hog markets. Lee?
Thank you, Dr. Meyer. What I'd like to do is just share with you for a few minutes here, and we'll try to wrap it up so we have plenty of questions. But as I see the hog and pork market outlook as we sit here late October. Next slide, please. So first, I think it's important to understand expectations coming into 2020, and then more or less realization, as we've seen tremendous change in markets from what we expected in January compared to where those actual prices were, and then even the remainder of forecasts for 2020. So what I've done here is took futures prices as of January 22nd, adjusted them for an Iowa, Minnesota basis, and then projected that out for the 2020 year. And that's how I do forecasts here at Iowa State. And you'll see that prices were rather robust, as we expected, much seasonality in the markets. And, as we got into July, August, very strong prices in that $80 to almost $90 range. Now, what changed obviously was the COVID pandemic, which impacted markets this spring and summer. And that orange line there shows what those prices were for Iowa, Minnesota producer sold hogs of all purchase types. That difference on average from February through December is about $14 per hundredweight. It was largest in July there at about $33 per hundredweight. Now you'll see here in October, November, and December, we're back to roughly where those expectations were. Next slide, please. Now, as I look at that December 2020 contract, so the near-term contract, you'll see that we've seen a tremendous rally since early August, gave us a very strong buy signal. We peaked out above $70 per hundredweight. As of yesterday, we were trading in that about $67 per hundredweight range, a little bit higher. And I think when you look at it from a pure technical standpoint, it was roughly, we're showing at maybe some resistance in that $67 to $68 range. I think if we can push through that level, we should see some upside on that December contract. Next slide, please. Now, as we look into summer contracts 2021, actually they're trading in a pretty narrow range. I think that we have some support levels in that $74 to $75 range, maybe some resistance on the top end of that 80 to 81 range, and likely to probably trade in that range here for the next several weeks until maybe we get more further information from a supply standpoint or certainly a demand standpoint. Next slide, please. Now, these are three forecasts that I provide here. USDA's forecast in their WASDE, which was released on October 9th. These forecasts are in USDA Economic Research Service and their livestock, dairy, and poultry outlook that was released about a week later. Livestock Market Information Center forecasts. And then the forecasts at Iowa State, which recall again are basis adjusted futures prices. So now the Iowa State forecasts obviously have the benefit of time here as I updated these forecasts on Friday to show you here that but overall we range for 2020 prices across all forecasts in that $58 to $60 to $62 per hundredweight range. Now that is roughly 10% below year ago levels. As you'll see, most of that occurred in the second and third quarter. There is some debate though about what this fourth quarter pricing will be from ranges below year ago levels to above year ago levels. Futures prices right now are suggesting those in that $66 to $70 per hundredweight range. Now, as we look into 2020, I think there is consensus of certainly higher prices as when I look at the futures market, that's suggesting about 14% higher prices. Most of that, again, is a large rebound in that second and third quarter pricing. And futures right now are suggesting about a $69 per hundredweight average for 2021 prices. Next slide, please. To give you a bit of a longer term perspective, I like to use USDA's and FAPRI's estimates of long-term projections, and I provide these at various time points. So USDA they made the forecast last November, would have released them in December, and then the full report in February. That's that red line there, which showed rather strong 2020 prices. I think that's what was suggested early on from the futures market. You'll see the FAPRI prices, which were released in March, were slightly lower, but still rather strong prices for 2020 and into 2021. Then you'll see FAPRI's update of their model in June and August, obviously reflecting the impact of COVID-19. Now, as we look at futures prices, they are trading in that $58 to $62 range, so much better than what FAPRI was forecasting even a few months ago. And then 2021 prices are in that $62 to $71 range if I look across all the estimates of forecasts from USDA, LMIC to the futures market. That is roughly actually where USDA and FAPRI had their earlier models to begin the year. And so I think it's important to understand that a lot has changed. Obviously, the outlook from late last year to early this year, but we're roughly in where those price expectations maybe were. And then to give you a longer term flavor, it suggests prices in that $65 to $70 range potentially as we go out. Now, USDA will revise these forecasts here shortly with a release in December of their longer term projections, which will reflect kind of the new environment, obviously from a supply and a demand standpoint, which may or may not impact where these prices are longer term. Next slide, please. Now, Dr. Meyer covered this very well, but just to highlight from a forecasting or projection standpoint, it's increasingly important to talk what price series are we talking about, because we've seen not only divergence seasonally as we look back to 2019, that divergence, but then also when we've seen these major market disruptions, much divergence in those prices. So again, when I forecast the Iowa Minnesota price, it is an all producer sold hogs weighted average of all purchase arrangements. And so that would show from comparing 2020 to 2019, we've seen about 12% lower prices, or $8 per hundredweight lower prices. But obviously that's varied tremendously from the biggest impacts to the negotiated price to the smallest impacts of the other purchase arrangement. Now understand that those are very differences in the definitions of some of those hogs potentially, especially when you look at that other purchase arrangement. Next slide, please. A bit on the marketing situation. This got a lot of attention and still does today, what those slaughter levels are. Here is barrow and gilt slaughter, federally inspected weekly. The data is through October 10th. And you'll see we're roughly at about a year ago levels. Been higher as you looked at July and August. Then we've had some holiday impacts there, and then roughly kind of where we're about par with year ago levels. Next slide, please. Now, this is my attempt to look at if there is any backlog when we look at the slaughter data. And so I don't really want you to focus particularly on the number, but maybe the regional impact and what occurred as we look throughout the year. So if you look at back to late March, I think it was pretty consistent with a pull ahead. We marketed some hogs rather aggressively. Basis levels helped dictate a lot of that. And so that created maybe a short-term buffer as we got into the packing plant disruptions. And then you'll see here as we got a development of delayed marketings, or a backlog, or backup as it's been termed many a times, really peaked as we got into late May, early June. And then we've seen those slaughter rates increase. We've seen seasonally tighter supplies. And so we continue to work through that backlog. Now, if you look at those slaughter levels, it would suggest that the US is roughly current right now. If you look at that cumulative change from year ago. And so, this graphic shows about 200,000 head that below year ago levels, or fewer since late March. But that is, rather small number compared to what it was. Now, if we look at regionally, you look at region 5 and region 7, which contribute a large volume of that slaughter, you'd suggest that they are rather current. Now, if there is a region that's not current, or regions, it is regions 4 and 8. The reason I've grouped them together, because USDA does not release that data due to confidentiality. So we need to group those together. But we know a large volume of those hogs are in North Carolina. And so maybe if there is a backlog or delayed in marketings, it is regional, and it is in that eastern region. Next slide, please. The weight data would suggest, again, we're rather current. The Hog and Pigs report had Iowa, Minnesota, South Dakota up 14% above year ago levels for the 180 pound and over category. Right now, those weights have been running roughly at par with year ago levels and slightly below. Next slide, please. I think when we look at those weights, and maybe not comparing them regionally, but also looking at the difference between producer-owned hogs and packer-owned hogs. So this is from the 201 report, and it shows that there's a $10 per pound difference in those hogs. That's the largest difference that we have in the data back to 2002. Now, if you look at the data, about 37% are producer or packer-owned hogs that have been marketed this year. So it's roughly a little bit over a third of the share. And I think this really mimics what the economics were. So as we've seen rather low hog values as we went through the summer, there was a lot of incentive for packers to buy those hogs. And so it kept those weights in check. But as we look at the packer-owned hogs, those weights have escalated well even above what we had seen this spring for those weights of over 220 pounds. Next slide, please. The latest Hog and Pigs report, which was released September 24th, had a lot of debate about that report. I don't want to go into that all that much, because I think a lot of the more recent data have helped both verify as well as contradict what was reported in the Hog and Pigs report. There was a lot of debate about especially the two heaviest weight market categories, which were well above pre-report expectations. Now, I think equally important, I think there's a lot of question about what those lighter inventories are, because those obviously have implications as we get into 2021 production, and when we look at those farrowing intention numbers. So those numbers well below year ago levels, but I will highlight that USDA has always typically here in the last several quarters have come in higher than those intentions. Also, a lot of debate about the breeding herd. It was higher than the previous quarter, but lower than year ago levels. I think there is a lot of asset fixity there. And so we maybe aren't going to see tremendous changes in that. There's been a lot of investments in facilities the last several years. And I will highlight that actually kept for breeding herd number is not that well correlated with slaughter. As you may expect. That number, what is a lot correlated with slaughter is obviously the pig crop and what makes up that pig crop. So the sows farrowed as well as the productivity or that pig saved per litter. So those are numbers to watch as we go forward. Next slide, please. As we take those slaughter levels or what the Hog and Pigs report suggested for those slaughter levels, that's that dotted line. And as we look at what slaughter has been since September 1, it's been roughly below year ago levels to about 1% below year ago levels. The Hog and Pigs report would have suggested it was about 9.8% through mid-October or so, and then jumped to about 6.1% above year ago levels. As you'll see here, we're very similar to those year ago levels, and which aligns roughly with about 95% of capacity for hog packing. I calculate that based on 5.5 slaughter days per week, and Dr. Meyer's estimates that were released this fall. The 5.5, or that accounts for about what we've seen on Saturday here the last couple of weeks. Next slide, please. Now, 95%, I think, is where, roughly where we're at, not at maybe 100% operational capacity. This is one slide that may highlight that as we look at the bone-in versus boneless wholesale values for hams. Last week, prior to what I report here, at 119, it was the largest spread we've ever seen in the data, back to April 2013. And I think that suggests where we've still seen a labor constraint at those packing plants, challenges there, and we've seen that divergence in value of bone-in and boneless hams. Next slide, please. As with futures prices, we've seen tremendous appreciation in pig prices, especially when we look at cash prices from summer lows of about $6 per hundredweight. Some sales at $1 or per head, at $1 per head. We've seen 471% increase in those prices. Prices as of last week were about $36 per head, $39 on a formula basis. You'll see that is obviously seasonally related, as it's following a seasonal pattern, but also those values are very much tied to capacity for hogs, suggesting that we have finishing capacity available, as well as the optimism or the market out there. And so futures prices suggesting stronger prices are obviously increasing pig prices as we see them. Next slide, please. Many of you may be familiar with the Iowa State model. I provide the fair to finish estimates here. This is a barometer of profitability. It's a hand-to-mouth model, no risk management assumed. Here it shows that 2020 is really going to stick out as an outlier, below break-even profits for fair to finish, wide range in that profitability from $27 or $26 per head loss to $25 per head profit, which is actually forecasted for October here. And this particular model or particular sector probably doesn't do justice to what was faced in 2020 by producers. If I would show the equivalent model for wean to finish, those losses were $30 to $40 to $50 per head losses as we've seen the major disruptions from COVID this spring and summer. And so realizing that there was a large impact on producer profitability this last year. But 2021 shows some optimism as obviously as futures prices have rebounded. That's how I'm making projections too, is I'm just using futures prices. Next slide, please. Now, cost of production, I don't want you to focus in on what the cost of production is, or as this model estimates here, we're estimating at $64 per hundredweight. We know that costs vary tremendously across producers, but what I want to highlight is the change. So that's a $64 or a $4 per hundredweight change, which roughly translates to an $8 to $9 per head change, or a 6% increase in cost. So costs are going up in 2021 as the futures markets currently suggest. Next slide, please. And along the lines of the wide range in profitability, I want to take you back to late 2019, early 2020 to show what the futures market had offered for potential profitability to lock in prices. Now, I was assuming a historical basis, so these numbers would vary depending on what that actual basis was, but it shows you that profitability at a particular point in time was about a $50 swing. From late 2019, could have locked in roughly $30 per head profit to down to $20 loss at the height of the disruptions. Now, we've obviously improved to about just below break even. 2021 is currently offering, from an annual basis, some profitability for fair to finish production. Next slide, please. Now, basis levels continue to go similar to the 2016-2018 average. So I highlight this just from a risk management standpoint, understanding those basis levels were very different in late 2019 and are going to be very different here in 2021 potentially compared to 2020. So anytime doing risk management, understanding what those basis expectations are going to be very important. Next slide, please. Cutout values are very strong. So from a seasonality as well as just a level standpoint. Next slide, please. And it's really across the board when we look at the various aggregate primals. And so all above year ago levels except for the butt. But I will highlight that it's very much, there's a lot of products that make up each individual primal. So just as I showed you, the ham is made up of bone-in and boneless, which are several products. That's similar to loin, that's similar to a lot of these products. And so there's quite a bit of variability within each individual product. Next slide, please. Pork and cold storage, really the levels haven't moved since May. When you look from a volume standpoint, hams are the largest below year ago levels percentage. It's from the bellies. The product has been moving tremendously efficiently through the supply chain and not even seeing much staging when we look at cold storage levels. Next slide, please. If you're looking for maybe not as much of a bright spot, when it looks at exports or movement, it is those variety meats. So I think this aligns with issues still at not full operational capacity at the packing plants. Some of that volume has been constrained when we look at variety meats, and that's brought those below year ago levels to the tune of about 5%. Next slide, please. But muscle cut volume and value has been very strong this year. So August levels were just slightly above year ago from a volume standpoint, value a little bit lower. But overall, we've seen for year to date, 22% increase in volume, 20% increase in value. That's come a lot from China, obviously, as we've seen tremendous ramp up there. But also you need to point to Vietnam has been a very strong market this year. Japan has been a strong market, and Canada has been a very strong market. Next slide, please. that was the official data through August. And if we look at the USDA weekly data, so this brings us through October 15th, the middle column there is accumulated exports. So that roughly mimics where we were in August with a little bit of changes, obviously, from the time standpoint. But I want to put your attention on the outstanding sales. So that's the first column on your left-hand side there. So that shows that Mexico we've seen tremendous purchases from Mexico as of late, quite a bit of volume of product on the books. And we've also seen increases from Canada, but maybe a little bit of weakness from China. But remember, we're comparing to very strong year-ago levels from China. And so it's a bit of a numbers game when you're just looking at percentage changes. Next slide, please. Some of this is when we look at exchange rates, especially when you look at Mexico, we've seen some strength in their currency relative to the US, and I think that's helped export levels as of late. But Brazil continues to be a very strong competitor from both a cost of production standpoint and because of the devaluation of their currency. Next slide, please. Now, as we look at exports, to end September, early October, we're at levels above what we were a year ago. With 3 months yet to go, this is going to be a historic year for pork exports. Next slide, please. But as we look at 2021, I'll bring your attention to this slide where last year at this time, you'll see the levels of outstanding sales that were intended to be shipped in 2021. Now, 90% of that was China, but a rather large volume compared to what historical levels are. And you'll see the purple line there is where we currently are. So much more in line with where those historical levels are. Next slide, please. A recent report out of USDA shows pork production rebounds in China and some slowing in the US, the European Union. I think some of the increase in China, I know there's a lot of debate about the size of that increase, but I think it is consensus that we are going to see an increase in those places and a slowing and potentially even lower production levels for the US in 2020. Next slide, please. All of that, I think, leads to where one forecast, at least from exports here from USDA, shows that US about at par for exports in 2021 compared to what we've seen in 2020. Brazil continues to see an increase in those exports and maybe slightly lower levels from the EU and Canada. Next slide, please. So I will end there and look forward to answering questions with the rest of the panelists.
Excellent. Thank you, Dr. Schultz. For those of you still on the call here, would encourage you to go ahead and submit questions on the screen here. But we do have a couple to get started to get things rolling here. Question starting off for Tim. Do we know what margin levels will be set at for the pork cutout futures?
No, we don't. Usually the clearinghouse will come out with those numbers probably about the week before trading starts. You know, in setting margins, they look at pretty much correlation over a couple different windows of, you know, how volatile things have been, or not correlation, but the volatility of the underlying asset. And in this case, they'll also look at margin offsets. Based on, you know, if you wanted to buy hogs, sell a cutout, or vice versa, and they'll come out with some margin offsets based on that correlation. But usually they'll come out with those numbers the week before something starts trading.
Okay, thank you. Another quick question, and Tim, I'm going to direct it to you, but both Dr. Myers and Dr. Schultz, feel free to jump in. What is the justification for only offering hog contracts during specific months, and why do they always expire around the 20th of the month instead of at the end, per se?
So that's a really good question. It has a lot to do with two things. One is history, and one is contract design. The contract design is, you know, there is only so much hedging to be done. And the more contracts you have, the more you're spreading that out. And particularly in the beginning, when liquidity is very thin, when there isn't a lot of trade going on, spreading it out means that the liquidity for any one of those given contracts is much harder to build. We've launched several grain contracts. Most recently would be Black Sea wheat, where we initially started with a contract for every month. And we found two things. Number one, it did spread out liquidity. You don't get more trade because there's more contracts, and you don't get more liquidity because of that. And the other thing is people just had kind of a natural tendency to wheat to trade the contracts where there was already a wheat contract. Now, I've only been here for 11 years and been in the business for about 30, maybe, I think Steve, not saying he's older than me and been around longer, but might have more of a history of why we have the months we do. Because if you look at any of the legacy CME or CBT contracts, you'd kind of look at it and go, I don't understand why they pick these months. But I know from, digging into these things, there's generally a reason, though it may be obscure to us today.
Yeah. Well, I wasn't around in the 60s either, Tim, but yeah, the question on that is, the reason we have the months we have today is because they started with them in the 60s, and we've seen from the introduction of the May contract that you don't just throw one in there and off it goes. Spreading is a really important part of the volume equation on any of these, and so anytime you throw another contract in, you have no history about how that price is going to be necessarily is going to be related to other contracts, and so the guys that like to spread are not going to use that new contract until they've got some history, and then so that gets you in this chicken and egg thing of, well, you go first, no, I'll go first. So, it's who's going to do it to get history so that somebody else will do it. So you get kind of locked in. Again, I wasn't around when we started with the original 7 contract. You might remember, anybody remembers the old Bellies contract. I think, Tim, there were only 5 of those, most of them in the summer, because it was a hedge against storage of bellies for summer bacon usage. And now, Tim, with that long-winded, I don't know, I'm going to pitch it back to you and ask you about the 15th. And I think that's probably mainly a historical construct as well, the 10th business day.
Yeah, I think a lot of the idea around when the settlement period is for something ties back to when we had physical delivery on contracts. And, it kind of makes sense from a grain standpoint. You could always say, well, look, I have a December corn contract, and it makes sense that I'm going to take delivery in December and that we're going to be kind of done before the end of the month. Now, why exactly it's a particular date in the month, I don't know. But having it in the month, whether it's cash settled or physically delivered, just ensures that it is going to converge to the price during that month. Now, the convergence is a little different issue with a cash settled contract. It's kind of straightforward math, so to speak. And it's not the same because you don't have the geographical issues that you do in a physically delivered contract. But the idea of having it, in that month is so that you do get convergence before the very end of the month.
Excellent. Great discussion. Next question here, and I'm going to combine a couple of them here. But from a historical perspective, any idea of what percentage of hogs are currently sold on a negotiated basis each week, and how has that percentage changed over the last, let's say, 20 years?
I can answer that one. The most recent data on a weekly basis has been somewhere around 1% of the hogs have been sold on North negotiated. And Lee, correct me if that's wrong, but I'm pretty sure it's very close. That has been going down steadily for And I'm trying to think back 20 years ago would have been really the beginning of mandatory price reporting. And I think we were at about maybe 12 to 16%, 15% or so at that point. And it has just gone down steadily the whole time period. Now, Lee, if I'm very wrong on those, please correct me.
No, Steve, you're spot on there. So yeah, yep, that's where we're at nationally. Now realizing what is week to week, we do see that number bounce around too. And so a lot of times we're reporting these in annual averages or monthly averages. But it is a very thin market and a very small percentage, obviously.
Excellent, thank you. We've had a couple of folks ask the question if this recording and the PowerPoints will be available, and the short answer is yes. If you are on this webinar, you were signed up to receive our Friday updates, and the benefits of that is this recording will be sent directly to you as part of our Friday National Pork Board Checkoff update. For another question, for everybody on the line, any rough estimates or was any modeling done on the percentage of pigs that may be contracted under this new offering?
Well, let me offer this. You mean, I guess they're asking about how many pigs we think might be hedged on the cutout value?
Yes.
Does that sound like? Okay. Well, all I can tell you now is we believe, we at Kearns believe there's probably about 30 to maybe 40% of the pigs in the swine and pork market formula basket that are priced off the cutout. Probably more like 40 at this point. And that number, and I'm sorry, I've had to shut my computer down here. We've got power problems in Oklahoma. Let's see, 30. I think that number has been about 32 or 3% of the total number of hogs in mandatory price reporting. So you take 40% of 30%, you'd be somewhere in the neighborhood of 12% of all the hogs are priced off the cutout. Now, I would say that the 35 to 38% of packer-owned pigs are in essence priced off the cutout because they don't ever have a price going to the packing plant. They have a price at the end of the packing plant. So if you add those up, then there would be roughly 50% of the hogs that are kind of extract, a direct price from the cutout value. And I would go further and say that really 100% of the hogs has their value largely determined by the cutout value. I'll let Lee add anything else he wants to add, or Tim.
This is Lee. I don't have anything to add now. Dr. Meyer, report all this historical values, but realizing that this potentially could change some of that marketing mix going forward. But that's just speculation at this point.
Absolutely, and I don't, Tim, I don't know if you guys did any estimates on how many hogs you thought would get, or how many of these contracts would get traded or not. But in most cases, I think the CME tries to come up with a really good idea and puts it out there and sees if it meets the needs of their customers.
Yeah, no, we don't really have a view as to, what percentage of the hogs we think are going to get hedged this way. And there's a bit of a disconnect because clearly we would look for to have liquid markets. You're going to trade, for each hedge, it's going to get absorbed into the market, and it may generate more than one or two trades as it gets kind of absorbed into the market. But we don't have a specific number as to what we think that would be.
Okay, specific question to Lee. How closely do weaned pig placements correlate to the USDA Hogs and Pigs report?
Well, that's a good question. I think wean pig placements from a volume standpoint, we don't have good data on that unless, Dr. Meyer may have a different opinion. But when we look at like the reported price for cash and formula SEW prices, that's a voluntary report. So I think it does pick up trends over time, but obviously it's not a lot of the volume. There is a lot of direct farm to farm transfers that wouldn't necessarily be picked up there. So I think it serves as a good barometer in the market, but it's not going to be one, at least that I haven't kind of paired with the estimates from the Hog and Pigs report to see if those numbers are align or if those numbers don't match.
Well, yeah, and Lee, I would just offer that I think you're right on all of those. Wean pig placements in the wean pig pricing formulas or report that comes out every Friday, the National Feeder Pig and Wean Pig Price. That's just a very small subset of all the pigs out there. The best number to get an idea on that is the quarterly average and then the monthly pieces that go into that for the pig crop. That would be the number that I think would be the best one. And, whether that is right or not, we always look back and that's one of the numbers that USDA usually revises to fit hog slaughter later. They're going to have a particularly hard time doing that this year because, hog slaughter for much of 2020 has not been determined by the number of hogs out there. It's been determined by the number of shackle spaces that are operating. So I think USDA has a real tough time in trying to even go back and back check their inventory numbers for the pig reports they've released this year.
All right, and with that, I'd like to take a moment to thank all of our presenters today for a job well done. Appreciate you joining us, and to all of our attendees, thank you so much for being on today. And if there's any questions we didn't get to, we'll make sure to follow up with you on those answers as best we can do. Thank you again for all your time, and have a wonderful week.